Hello everyone, welcome. Uh, this is the time for another weekly update. Let's get into this. We've been spot on. Our last weekly update has been incredibly accurate in terms of highlighting what is likely to transpire in rates and in currencies, and obviously in stocks. Therefore, we played it very well. If you remember, we've been calling for a nice run up, a continuation in the previous run up in stocks. Especially, we've named the stocks like Nvidia, Meta. If that is, we were mentioning it on a short-term basis. Short-term basis has been working pretty nice for us in stocks. Okay, let's go through all of this once again and compare the previous week to the upcoming week, to the week that we have on hands, and what are we thinking. Starting with rates, as always, we start with rate sensitivity complex because it has been moving, has been the most important dynamic in the market. It has been moving everything else. Rates have been moving currencies, equities, credit, to some extent even in commodities, world equities, world credit. Obviously, everything has been hinges around US rates. And let's start with the short end. Any market expectation? We've been saying the previous week that this move in short end and this repricing of rates lower on the short end and in SOFR in euro dollar, it just didn't make any sense to us. Okay, the move in long end made it was as clear as day. Essentially, less issuance, less than market expected, slowdown in a rate of change of increase in issuance made the TLT pop very nicely and made the rates drop. Once again, underlying dynamic has not changed at all. We're still having a shitload of issuance, and we are seeing the problems of private sector absorbing that issuance. The last 30-year auction has been incredibly poor, to say the least. And these events are likely to, because we are going to get a lot more of these auctions, and probably not a lot of them will be perceived and absorbed by the market as nicely and as easily as we've seen with the previous ones. Once again, the rate of change of issuance has slowed. We've increased it by only 10 billion. Market expectation for a much larger number, but it doesn't change the fact that we're still issuing, if I'm not mistaken, 350 billion in coupons still. So there's still a shitload of issuance. So the trend in long bonds, in long-term yields, hasn't changed. We've seen this move. We've just broken the trade, meaning we are likely to see the negative price momentum over the 1 month to 1 week to 1 month on the 1 week to 1 month basis. In terms of the short end, I guess because the whole curve dropped on the announcement, and we just seen the realization of reality. Reality setting back in, and the twos are repricing back higher once again. And tomorrow's CPI report should come. There is a probability. Essentially, the consensus, the previous one was 3.7. If we're talking about the headline, 3.7 was the previous one, and the expectation is for it to drop to 3.3. The risk is to the upside, I am afraid, and if CPI indeed comes on a hotter side, then twos will pop once again even more. Nothing has changed in the on the short-term basis, even on a medium-term basis in the short end. And from the perspective of the Federal Reserve policy, if they're still sticking to their inflation fight, they should not be easing. And at some point, market and the Federal Reserve will have to recognize the stickiness of the inflation. Without a recession, they're not going to get inflation meaningfully below their target, and meaningfully and sustainably below their target without a recession. It's just simply history points to that fact. And we're not getting a recession. We're not getting a recession anytime soon, just because of the. We could have gotten it if the long end has been around. Let me say it this way. The key to the quantitative tightening lies in the hand of the Janet Yellen of the Treasury and their issuance of long-dated bonds, not in the hands of the Federal Reserve. Essentially, they've already they did everything they could with the short end and with raising the short end of the curve, and it didn't have the desired effect on the economy, on the market. But the long end, we've seen the move, how correlated these stocks are. We need to get the stocks down, and the only way they can get the stocks down is by raising the long end, and the only way they can raise the long end is by issuing more coupons, essentially, tinkering with the supply-demand dynamic, and they decided not to do that. That's fine. We're back to the square one, and we're back to the regime that we've been in all summer, and we will talk about this regime a little bit in the detail. So the short end, nothing has changed at all. We are still within the probable bands. We still are. We said the previous weekly update. We mentioned that, okay, this is interesting. Are we breaking the trend right here? Because if we are, yes, okay, then we're gonna see that then the market is telling us something. The machine is telling us something, but we didn't, essentially. We needed to wait another week for the confirmation, and the confirmation just didn't come through, and we still maintaining bullish trend on the twos. And that's it. We're not going anywhere. And if I would argue that we should see, because of that fact that we yields on the long end dropped so significantly, so fast, and SPY rebounded so significantly, so fast, and to that extent, and Qs rebounded that much. No recession coming anytime soon. Therefore, there might be a possibility. We still getting 2 CPI reports by the end of this year. 1 unemployment report. Let's see. Nothing to do in the short end. Obviously, there will come a time. There surely at some point there will come a time, but it's not now. The biggest risks in the market currently, just if we talking from looking at the market from the 10-foot view, is either some exogenous event, let's say significant war breaks out, causes a oil shock or something like that, geopolitical, let's say this, or another round of coupon issuance, because at some point during the next year, in order to satisfy the debt and the deficits, they will have to issue more coupons, and we will have to see another step function in the issuance of the coupons of the long-dated bonds. So essentially 350 billion, it's not the high, it's the low, and we just need to see how high that we're gonna get during the next year. They're projecting deficits to be much less than this year, into deficits to be in 24 less than in 23. But usually these numbers, the government numbers, the BOE, CBOE estimates are, the government numbers are never correct, so there's no point in relying on them. I'm not saying the deficit is gonna explode the next year. But the fact that we're still getting 350 billion, and on top of that, we will see another step function. Whether they're gonna issue more, we have how much more we don't know, but we will see that step function, and maybe by that time, we will see another rise in long-term rates higher. Right now, we are calling for consolidation within the probable trend boundaries, within the twos and in the long end as well. Unfortunately, inflation dynamics are not going to impact us too much, in the markets too much, and we're not going to get a significant reacceleration. Neither we're going to get significant rise in unemployment, nor are we getting significant rise or fall in inflation during we're talking about 1-2 months ahead. And if that doesn't happen, then once again, we are in the environment that we've been in whole summer. Twos are not going anywhere, and tens are not going anywhere as well. That is incredibly positive for SPY. SPY goes higher, SPX goes higher, equity goes higher, recession delayed even more, inflation is even stickier, and stickier, and at some point market will have to realize that inflation is sticky enough and it's not going anywhere without a recession. And then either break-evens will have to expand and by the long end going higher, and the long end will have to, the term premium will have to expand even more, and that's what will be holding the bonds in the range, maybe even an upward sloping consolidation. God knows, we shall see. But when the time comes and we're getting a recession or anything like that, if you expect a recession, if we see some problems, if we even see a new bound of inflation coming, which is much less probable, there is a play that we are looking at, and it is very interesting. Essentially, a synthetic steepener. You can implement, even if you are a retail trader, you can implement this, and very nicely, much easier than to go DV01, and you just need much less capital if you are interested in that. Than to play in futures market. That we're talking about PFIX, TUA plus PFIX. This will, as we've seen right here, this will work very nicely in a bear steepener dynamic or bull steepener dynamic. If you just have to time it properly, and that's what we've been looking at. If we think that recession is coming, and we, at some point, right here, right now, we will have to start to reprice the market expectation. We'll have to reprice lower in terms of cuts. Then this will be a good play to put on. And if we expect another bear steepener, as we've been calling for it, we will get another round of treasury issuance or inflation is coming back. Then this is a win-win situation essentially. It's not the time to put this on, but we are very closely observing it and looking at this. Okay, in regards to the 2-year yield, we've discussed we're not going anywhere, and I think we're going back to 5.1, maybe back to 5.2 during the next 1-2 months. But it's nothing. It's almost nothing. There's nothing to talk about. There's nothing to do right here. There is no trade to be had. This has an implication, obviously, for the currency market, because let's plot this out. Now, let's US. Let me put this on 10-year on top of this. US 10-year. Let me put the GLD on it. And let me put the SPX on it as well. Now it's kind of crowded. Close this. I think we will be able to discern the dynamics. Let's take a look at the first at the 10-year. At the 10-year and at the, that's a 10-year only. Well, let's then put the 2-year also. So this is what we have. It is, dollar is incredibly, obviously there's nothing new for you right here. It's incredibly correlated to the long end. We've been, whole summer we've been since the beginning of this year in this relative stable dynamic when the tens have been consolidating within, we have been saying within a range, and twos, well, we've seen twos within the range if you discount for this banking crisis that we've seen, but pay attention to the tens. We're staying in consolidation, we're not going anywhere, and these waves, these rides higher and lower, they're incredibly correlated to the dollar. Right here, we're receiving a low in inflation. We're receiving this 3% inflation coming out at 3%. Incredible reaction from the dollar, taking out everybody who has been short or long the dollar right here, taking out the tail support, and then new bout of issuance came onto the market. Tens repriced higher significantly, not so much the twos. Obviously, twos are not going anywhere, and they will not go anywhere. But the tens repriced higher significantly, and the dollar went in bear. So right now, if you look at this, this is a very important signal. despite the fact that we still expect two-year yields to stay in consolidation and 10-year yields to stay in consolidation, we expect the dollar to stay in consolidation. Essentially, without this move, nothing bad will happen. It's like there is no reason for the market to. Market doesn't need a reason, if we're talking about the equity, to go up. It needs a reason to go down. If everything is stable, it's relatively normal. Your passive flows just gonna flow into the market, and we're gonna go up. We're gonna slowly go up. Especially the Mag 7 is definitely gonna be feeling well. And this is reflected in the signal for the 2s. This is reflected in the signal for the 10s. We broke the trade. The trend is still positive on the 10s. We're waiting. This week will be a confirmation. We will update you on that. But this rate sensitivity complex is pointing, whole rate sensitivity complex. We can get to high yield, to BKLN, so everything that we can look at is pointed to the continuous consolidation, especially the US, at the US. And dollar broke trend as well. So what we do not expect dollar essentially neither long neither short. There is nothing to do right here. Honestly, there's nothing to do with the euro and nothing to do with the dollar currently at this. If we're talking about this week to upcoming month, so we expect the dollar to stay in consolidation right here, and rates to stay in consolidation because of the incredible correlation, and all of them broke the trade. If we look at the, oh no, yeah, let me put the GLD back on, let me delete the tens, let me put the SPX back on, let me actually put the tens again. GLD, let's not discuss. So once again, a yellow line is tens and SPX is a blue line. I don't know how to change the color. It doesn't like, I don't like the color. All right, it's visible, I think. Visible enough. SPX is mostly negatively correlated to the dollar. Correlation has been dropping significantly over the past 6 months, but it is pretty correlated. This move, you can see what was happening when the 10s stayed in consolidation right here. We've first SPX shifted into a positive trend even before that. Right now, this whole period we've been long SPX, and this is a excluding this debacle was with the banks. We were out of the market right here just to see and wait how this whole thing transpired. This is a positive. I would expect, it's not necessarily I would expect the same magnitude of a repricing in SPX right here, but it is definitely something to, we are neutral to positive on SPX on the market as general. And we did break the trend on SPX the previous week. This is significant, where this is a very rare signal, but it's a very significant signal. I would expect some sort of consolidation and continuation higher, maybe even to see 4,600 again in SPX. I don't know if that's going to come by the end of this year, but the dynamics is very positive. Current dynamics is very positive for equities. Because this retracement just came on the back of the bear steepener that we've seen. The bear steepener is largely over, and there is nothing to reignite the bear steepener at some point. At this point, inflation is not going to do this unless it reaccelerates very, very meaningfully, which is very unlikely at this point. Not in the next 2 months, definitely. So this is the thing. Rate sensitivity complex is pointing to the consolidation. So how are we looking at this? We're just looking at the whole. The unity of the market, and we decide what's the best risk reward. We can go in equities, we can go in currencies, we can go in credit, anywhere you can go, and just looking for opportunities for the most visible, easily, the most easy to implement, the most elegant, and the most asymmetric opportunities. Right now, they are not in currencies. There's nothing to do in currencies, honestly. Nothing to do in dollar, nothing to do in euro, nothing to do with pound. Yes, we've put USDJPY along. We've been mentioning this the previous update, just because we wanted to play this USDJPY. Essentially, it's just 90% correlated to the short end in the US, and we've been repricing this. We've been thinking about this renormalization in short end, because this breaking trend didn't make any sense to us, and this is why we're seeing this positive reaction in USD/JPY. Essentially, a very nice, very interesting move. And there you get this BOJ meeting, incredibly fast repricing higher. Then QRA comes out, the whole curve drops in the US, JPY drops with it, just engulfing the entire move and then engulfing it back again. We've been playing this potential engulfing, and inflation comes out higher. If inflation comes out higher than expected tomorrow, higher for longer, sticky CPI, JPY is just going to once again drift higher and higher and higher. We are holding JPY longs, holding the longs into the CPI report. So this is the one play that we have in currencies currently. This is it. MXN JPY, very nice thing to have. After the CPI, I think all is clear, and you can put in the MXN JPY longs. You can do the carry trade. You can do whatever you want right here. You have to be very careful, obviously. We have to be very careful with USD/JPY. This is the area where they're going to intervene. We're definitely going to see another intervention for the BOJ if we're going to get into the 153, 154. But generally, this is a very good environment to put on the carry trades, really. If we're looking over the next 1 month, the skies are clear. Long USD/JPY, long MXN JPY. If that is, you can stomach that volatility. USD/CNH, yes, we've been calling since right here. We entered USD/CNH long, and we've been calling for long, continuous, saying that this has to reprice higher, and then rate complex in the US dropped significantly. The dynamics shifted 180 degrees, and obviously this has repercussions for the USD/CNH as well. So yeah, in itself, CNH is very weak. They need to devalue this, but it's there are two sides to the pair, to the currency exchanges. And if USD weakens and breaks trend, how can USD/CNH not react to this? Obviously. So we are out of our longs. This was a very good long. We entered in and around right here, 717, if I remember correctly, and we exited on this break. That's it. There's nothing to do in the USD/CNH currently, unfortunately. This is the currencies. Nothing, generally nothing to do in currencies. You know that if there's something to do, if there's a play to have, is that the volatility, we see the volatility coming. If the rate complex, if maybe rate differentials or anything else is pointing to that fact, and the signal is pointing to the fact that there is something happening, something brewing in currencies. No, nothing like this. Absolutely nothing like this. So nothing to do right here. All right. Let's not waste a lot of time on the other pairs, and then how can we not talk about the Bitcoin? I'm repeating myself every single time, but we have our take on Bitcoin. We do not care whether it becomes an next reserve asset, whether it goes to 1 million, maybe it goes to 0 or any. We have these systematic trend following strategies. That's the strategy that we're implementing. We're managing our 7% of our capital is allocated to this strategy. It has been pretty successful. The backtest has been pretty successful, and our real-time implementation has been really successful also. If you remember, we started implementing this strategy in and around this period, but the signal at that point, obviously, it was negative. We've avoided all of this drawdown. First time we entered before the FTX happened, we took a 7% loss. I remember that vividly. Took a 7% loss on this drop lower, exited the market. That's totally fine for us. 7% loss is very nice for the potential return that Bitcoin can give you. To take a couple of false signals of the magnitude of 7, 10, even 20% is completely acceptable to us. Then we got into the market right here after stabilization. Bitcoin has a very only Bitcoin exhibits these interesting tendencies and patterns during the periods of very low realized kind of volatility, usually after a significant drop in price, or before after a significant drop in price, it exhibits the very low periods of exhibits very low realized volatility for maybe a month or so, and then we are getting these monster weeks, monster moves, one or the other direction. We've seen it a couple of times. This was 1-to-1 from the perspective of the pattern to the thing that we saw the previous, the previous cycle right here. Maybe I'm not saying anything new to you, but this is just one of the patterns that we are incorporating into the signal. Incredible period for low realized volatility, then a significant repricing to one side, then incredibly low period of realized volatility right here, and then significant repricing to another side. Same thing was right here. These are your trough. This is your low of the previous cycle. This is your low of this cycle. This happened much quicker than the previous previous instance, a couple of weeks essentially, maybe a month, and then we off to the races. We've been able to recognize that before it happened. We shifted pretty decisively that week. We shifted into the positive trend territory, and we've made 55% on that move. 55% in a period of a couple of months. No, in a couple of months, 5 months or something. We exited right here on this week because of we've written about this, that we do fear that there is a potential significant problematic move in the long bond coming. We're getting this bear steepener, and this is negative for everything. If SPY goes, this guy is going to go as well. And we've seen this, and Bitcoin essentially dropped even before everything else dropped. It has been exhibiting the much faster response function to the negative news as well as to the positive environment. It shifts and recognizes it faster than anything else, especially than equity. There is very low correlation to the equities on the trade basis. On the trading basis, it's much more higher, but on the trade basis, there's the correlation that we've once again seen during that move to equities has essentially disappeared. But we made 55% right here, exited right here, and we've been waiting patiently. On this week, we shifted into the positive trend once again, and now we are sitting comfortably as of now. So, is there any insight that I can give you as to the Bitcoin? I can give you my opinion. The value is in the signal. We are in the market. Is it the time to enter the Bitcoin from the perspective of the signal? It's obviously not. If it hasn't entered with us, you already missed it. You cannot just pick it up in the middle of anywhere. You have to enter when the signal changes. Only that way the math works. Methinks, my opinion, is the upcoming year is going to be very positive for the Bitcoin, and at some point during the next 6 months probably we're going to reach 48,000. This is the tail resistance. We're going to get back up right here, back up here. If you look fractally and you compare, do the silly thing of comparing the current cycle to the previous one, we are currently let me pull up this thing. These are the futures. The halving is coming in April, 22nd of April. We are somewhere in that region, right here. We've been long Bitcoin in 2020, expecting this to be finally the beginning of a move, of a significant move in Bitcoin. We've been quite comfortable in saying, and confident in saying that we're probably never going to revisit this low again. But obviously, we all know that unforeseen and things do happen, especially of this magnitude. This was I don't know, 5 standard deviation move, a very unusual thing happened, and then off we go because of the response function of the governments. I would not expect to see this time around the same move and the same magnitude of the repricing lower. It's not to say that we're not going to revisit 24,000. There is a possibility that we're going to revisit 24,000, but I do not see us dropping significantly and meaningfully below 24,000 during the next year at all, essentially. There are a couple of risks. Once again, let's go through them. These are the risks that are negative. They are essentially the same for crypto and for the equities as a whole. A credit problem, credit event, a significant credit event. The average maturity rate of the high yield has dropped below 5 years. There is a credit event brewing, and it's probably just a matter of time when we get a expansion in credit spreads. And when this happens, we are going to see a fast and meaningful repricing in all risk assets lower. The bankruptcies, they happen unsuspectedly, so it's nothing that we can predict, but we don't see this coming in the next, once again, 2 to 3 months. So we can that's as far as we can look, 1 to 3 months at most. We have no idea what's going to happen in 6 months or even a year, we have to prepare for everything. But this is one of the this is on the table. There's definitely something is brewing in credit space, and this is one of the risks. Is going to realize in the next 2 months? Probably no. Most likely not. Therefore, we adjust our positioning that one. But this is the risk. One risk is credit event, significant risk, and this might pull SPX significantly lower, and therefore we might see a significant move lower in crypto as well. Just a risk of environment. But obviously, we all know what the response function of the governments will be, of the Fed will be during that time, if it's going to be significant. This is just if history is any indication, it will create another buying opportunity essentially. Another thing is once again exogenous event, a significant problem in the geopolitical sphere, and inflation, which will probably most likely will cause significant inflation and cause its own problems. If we see that happening, yes, this is going to change all dynamics in the markets significantly. These are the two things: exogenous event and endogenous event in the market, financial markets. Credit event, geopolitical shock, and another repricing of long-term rates higher. The bear steepener, another bear steepener. If we're seeing this, it's once again, neither of these things currently is likely to happen over the next 1 to 2 months. We think that. We think. Because we can only think of it. There is no way of predicting this. There's a way to prepare for this, and we are talking currently about the short term and making the short term decision. We can just adjust ourselves, recognize we are in the markets every single day, and we can prepare and proactively predict, and be very flexible and change our positioning. That's the only thing that we can do. But I do not see the same magnitude of repricing and in crypto this time around. So methinks that we're gonna see just a before the next run up. We might stay in consolidation within that area, and then maybe continue higher from here. Once again, from the perspective of the signal, this is not the time to get in. Overall, how we played this. Yeah, when the signal changed, obviously we bought Ethereum and we bought Bitcoin spot. What we did also is we entered coin. Yeah, I know. A lot of people don't like all of this stuff, but we just trade correlations. That's it. That's all we can. Just people are completely fundamental guys completely hate MSTR. I have honestly no opinion on MSTR. No, I do have opinion. I do have fundamental opinion, and I understand that this is just a struggling, stagnating tech business, software business, and that's it. And they just hold, what is it, billions of in the dollar equivalent of Bitcoin. That's it. But we trade correlations. That's what we do. And if it's going high, why cannot we make money on it? Of course we can. And MSTR is incredibly much more volatile than Bitcoin, and there is a good chance we see MSTR at 1,000 if Bitcoin indeed will print the 50,000, let's say. But what we did with coin, because it's also bullish trend, bullish trades, the correlation to the Bitcoin is positive 75 in the 75-80 percentile. We bought leaps on coin, 150 out of the money. It's well, you cannot consider out of the money calls leap, but we bought long dated out of the money calls on coin, 150 calls on it. and we're just selling. We're collecting credits by selling the shorter dated, much more shorter dated, maybe 20 days out, 6 delta, 7 delta calls on it. Just collecting credits. That's it. That's how we doing this. If we expect, when we expect the next year to be very positive for Bitcoin, and we expect Bitcoin to reach 50,000. Once again, we do not need a massive repricing to 1 million, something like that. 50,000, and if a coin prints this move, once again, something like this, and it's very easy for it to do this. It's an incredibly volatile name, incredibly speculative name. If we are getting some sort of repricing right here, what is it? This was a 100% move. This was a 100% move. We're getting from here with any sort of volatility from here. We do not care. From here, if we're getting this move higher, let's say 80, 90, 100% move, just a replication of this when Bitcoin goes to 50,000 at some point. Maybe this will happen in the next 6 months. Maybe it will happen in the next 7, 8 months. Maybe it will happen. It will even happen in September. Let's say that. We're still fine with that. We shall see by that time, obviously, if we are going to roll our puts or we're going to stay with the same ones and just keep collecting credits. But if we're getting this move, during that move, we're getting a meaningful expansion in volatility. And our out of the money 150 calls should print money, honestly. If we are getting, and it's very reasonable volatility right now in that expiration that we bought 17th of January 25 is 75%. And to see the expansion during such a move, to see the expansion to the 85, 90%, maybe 100%, I don't know, but we shall see. It's very reasonable, and the magnitude of the move is unknown to us, but the risk that's very preferable. We really like that risk. High leverage, we think the small risk to the potential reward. Because why? Because why is a small risk? We are going to be out of coin if it breaks $70. Obviously, this is the positioning. If it's gonna break the tail at some point. Even if Bitcoin is positive and it holds trend, it holds trade, but coin is completely decouples from Bitcoin and breaks the. I have no idea why that would happen, but let's say if that does indeed happen and the correlation just disappear between the coin and Bitcoin, of course we will recognize that and we will close our position. But as of now, the correlation is relatively positive. Very positive, let's say that. And this is how we're playing this. Out of the money, long-dated calls on coin, and generally long Bitcoin currently because of the signal. A signal, we are very happy with the signal, very happy with it. Very nice track record, and we shall see. I honestly, that's a very interesting question. Is this the last positive signal that we are going to get before the major run-up? Major, not major, I don't know, before the run-up into all-time highs, if history repeats itself, and Bitcoin and the macro environment is relatively positive, and Bitcoin goes back to, let's say, $65, $68, $70,000. Is this the last signal? Is this the signal that we received last time, right here? And it's just late for you, and for the next 7 to 8 months, we're not going to get any change in signal, any opportunity to get back in. I don't know, honestly. This is the risk, but we are in the market right now, so that's fine. If we're gonna get shaken out, if we're gonna get a significant move for a lower, we shall see. Okay. Bitcoin is positive. Ethereum is positive. Ethereum is very interesting. Once again, usually I've been repeating myself, but I have to repeat this. These are very important things to say. Ethereum always lags Bitcoin, always, as we've been trading this for a long time. The previous cycle has been completely the same. This move in Ethereum happened, I don't know, honestly, a couple of weeks after the move in Bitcoin happened. So same thing right here. Ethereum is positive. It's staying below that level. This is a very meaningful level of resistance. We've been under it for a long time. It's originated from here. And just when we probably, it's very reasonable to assume that as Bitcoin broke the 30,000 range right here, yeah, this visible and obvious level for everyone, and we've been calling for this break even since this consolidation. It just took much more time to do that. At some point, we are probably going to get a nice move higher on the back of shorts right here. I don't know when this is going to happen, but we are holding Ethereum, and this is nice. It's very reasonable for Ethereum to reach 3,500, 3,600, something. If all else equal, okay. Even the crypto market, total market cap excludes BTC and Ethereum. Is printing new highs currently. Bullish trend, bullish tail, even bullish tail and bullish trade. A positive setup for the whole of the crypto market. That comes on the back of the consolidation race. That comes on the back of consolidation in the dollar. That comes on the generally positive environment overall. We've gone through currencies. Man, we've gone only through currencies and Bitcoin. And this video is almost half an hour or something. Takes so much time to talk about these things in detail. Next up, oil. Nothing to do in oil, honestly. We've been calling for short on oil, the short-term short on oil, and the possibility of selling strangles on it. Once again, we would expect oil to stabilize in and around these levels over the next month. So I don't like selling volatility and selling strangles on oil in general, so we're just not going to do this, and we just out of the oil markets altogether. I would expect something like that to repeat itself, maybe, but we captured this move higher, and now we're out of the market and just waiting. But the oil, gas, nothing to do in natural gas for us. We've been, once again, I'm repeating myself, we've been looking for calls, to buy the calls over the December calls, but no, we're not going to do this. Signal, it has changed into negative territory, so there's nothing to do with natural gas. Yuan, this is a gift that keeps on giving. This thing is printing higher and going higher, sprinting, jumping, just beautiful. Tail dynamics is letting itself known. Huge consolidation and then repricing. We are in the repricing territory. If we talk about the yuan and Iranian sector in general, be long yuan if it gets low. If you don't have the position and it gives you a retracement into the 24 region, I would buy that right here. We bought this last time. We bought this was 3 days ago, or when was it? At the close of this day, because this was a signal. This is COD. This is our proprietary signal, and we entered, and now we added to the position. If you recall, we've been saying that we closed 50% of our position. Now we holding. Now we've been looking for the opportunities to add to the position, back to the position, and we indeed added a little bit, not to the extent that we wanted to, but CCJ keeps on going, keeps on giving, and CEG keeps on giving as well. Beautiful things. We have our basket that we've created: CCJ, CEG, NXE, and FCU. But yeah, these things are the strongest from the signal perspective, and this is it. Be long of yuan, be long of uranium itself, and be long of the related equities. However you want to play this, but there has been plenty of opportunities for you to get into the yuan. Gold, just a reflection of rates. I would expect nothing, complete nothingness on gold once again. Some sort of this thing happening again. We are, until we get resolution with rates, gold is not going to go anywhere. People are calling for another repricing and continuation lower in gold just because of the fact that what's going on with rates. No. We are most likely staying in the consolidation right here, maybe even in upward sloping consolidation. There is no point, absolutely no point in trading gold on a short-term basis. It's a very hard instrument for that, but we've been saying for this, and I'm repeating myself over and over again, this incredibly good hedge to have. If you expect recession, gold is your play, not the TLT. If you expect recession, gold is your play. Bear steepener is your play. This is much more lasting and easier play to implement. Now, if you expect a reacceleration in inflation, gold is your play once again. Why? Because unlike the previous time, if we get a meaningful reacceleration in inflation, they will not be able to raise rates significantly enough. Well, they can. Let's say they raise to 8, 9, 10. They destroy the economy completely, and then what? Then recession. And then they're cutting rates. And then what gold's going to do? It's going to do just fine. It's just a matter of whether we're going to see this or whether we're going to see this. That's it. There's nothing to, currently, as with Bear Steepener, as with our call for consolidation in currencies from rates complex, there is absolutely nothing to do with gold on a short-term basis, and we still hold our longs, our portfolio longs, and we're not planning on closing them. So this is our take on gold. Nothingness, complete nothingness. Therefore GDX, therefore silver, and that's it. Commodities. Honestly, let's not gonna go. We've been thinking. The one play that is visible to us right now is getting long of steel stocks in the US, but let's leave it at that. It's not not the most crucial one, and we haven't decided. We haven't made up our mind yet. We've talked about the steepener. We've talked about the rates, short-term, long-term rates. Yes, the SOFR. This is December 23. We've seen this repricing higher, and now there's just a meaningful and reasonable return to normal. Nothing's going to happen right here. The rates, in Europe, we broke trend in European rates in Germany, in Great Britain, in Italy, France, everywhere. This is just a signal of potential recession, I guess. Recession, which is much more closer in Europe than it is in. Than it is in the US, and the reflection of a different CPI dynamics, inflation dynamics. But we don't trade this. We just look at this as a correlation confirmation to our signal in the US rates. So this is how we're thinking about this. Okay, the next thing. Credit, a couple of names in credits. High yield, just positivity, just everything is fine and dandy. Once again, because of the long end is not going to go anywhere. High yield is going to probably exhibit this type of the move, unless obviously we're going to get a credit event, which is completely unforeseen, but we will see that when it's coming at some point, or after it already happened. It's either right here or complete nothingness. But nothingness is good for equities, once again. The signal is bullish trend, bullish trade for high yield, bullish trend, bullish trade for SHYG, for emerging market as well, for EMLG, DXY, EMLC is bullish trade, neutral trend though. So the credit has stabilized after the bear steepener. LQD broke the trade as well, very positive, very nice. LQHD, same thing. BKLN, same thing. PFF, BCY, mortgages stabilized relatively well. Everything is good. Everything is fine. No immediate danger right now. Unis and all that stuff. Okay, let's get into the equity then. The CPI, tomorrow's CPI, probably not going to have any impact on, if it comes out lower than expected. I would think that we're definitely going to break into the positive trend territory on SPX. We'll break in this trend resistance and we're going high. If it comes out higher than expected, now we're going to just consolidate a little bit more and then we're going to go higher. But I guess it's a given. That's the fact that we're going to probably revisit 46. We're talking, that's micro E-mini. Let's open just E-mini S&P futures. My bet is that we're going to reach 4,600 by the end of this year. As I've been saying that we're going to reach 4,150 by the end of this year, and we did indeed touched it. Let's say this is the concept of last liquidity. Right now, there's nothing stopping us from going back to 4,600. This is the trade. If the CPI comes out hotter than expected, I would be, and we get some sort of a move lower, relative. I think it's going to be relatively a benign move lower in SPY. We're going to be buying this. We're buying everything right here with an expectation with over repricing higher in SPY and in SPY, SPX, and all of that complex. So, yes, this is a given by the end of this year, I guess. If we talk about the SPX, it's 45.40. How we think of playing this? And QQQ obviously is on the frontier of this move. It looks extended, but usually it can get much more extended. The plays we've been. No, there's nothing to do in oil, as we said. There's nothing to do in ITA. We've been looking for potential short puts on ITA. There is a short put potentials on ITA, Visa, MasterCard. Very good environment to short volatility. Very good environment to put on some income trades, tactical income trades. Very good environment to get long of stuff in general. Same thing as DXJ, EWJ as well. Japan is going to behave very nicely. Okay, let's concentrate on equities in the US. Last word about the China. Nothingness in China. Continuing nothingness in China. I don't know. Biden and Xi Jinping meeting in a not so distant future, and I don't know whether there's a positive or negative impact. There's generally nothing to do with currently in Chinese equities. They do report earnings this week though. BABA, TME. One thing I would potentially look at is play the earnings. Maybe be a little bit directional in terms of our earnings. Plays on the long side. On the long side, that would be interesting. Mainly Alibaba and TME. And TES is also reporting, yeah. So, yeah. That's what maybe play earnings to the upside on these names, but because usually how that happens, they are very depressed, but the earnings coming out usually very nice, and you see every single time you see this pop up in price on the back of earnings, on the back of relatively good earnings, and the environment has stabilized somewhat for Chinese equities and for the CNH on the back of the weaker dollar, and there is a good chance that we can pop up once again in some of these names. So this is the way we play. Maybe put some verticals, or maybe even depending on volatility, we're gonna put a skew to the upside strangles. We shall see. And the main event, the big boys, all of them. Oh no. Google is struggling currently. Bearish trend, bullish trade though, but bearish trend. So, what can you do with Google? This FP. I have no words to say. Apple is bullish trend, bullish trade, and Microsoft is bullish trend, bullish trade. Amazon, Netflix, Meta, all of them feeling very nice, very good, and this move is likely to continue. We really think of we still have longs, and we add into those longs, and especially adding to Meta. I would really like to add to Meta, just probably by outright calls. We're probably gonna revisit if the CPI SPY goes back to 45.50, and then Meta is gonna go to 350. Very nice setup in Meta, very nice setup in Netflix. Microsoft is already all-time highs, and I do not see why we should stop. Maybe in the next CPI print we'll get an opportunity, give us an opportunity to buy. Apple, I don't like the earnings. But once again, it's not about, as you can see, it's not about the earnings at all. It's not about the fundamentals at all. The sales growth, what was it, 0%? This is not a growth company anymore, and just flows, nothing else. And if we are correct in our understanding of the current environment, Apple is going to go into the all-time highs. Is the biggest beneficiary. All-time highs for Apple. Let's go, baby. Tesla, even this piece of shit is hanging in there. This will be a nice short once again, but I would just, with this new Cybertruck coming out with the pictures, oh my goodness, with the generally the fundamentals of the company, I don't know. I do not see that people are that excited of Tesla, and Tesla's just gonna rise because it's Tesla, and because once again, if we are in a relatively positive environment, Tesla is doing good. I don't think that's. I think me feels that the general exciting allure to the Tesla has just disappearing, and it's just gonna underperform overall. We don't have any positions. If market flips, and this probably will be our favorite short once again, but I'm definitely not going long. Even if it goes to $314 and $500 once again, I will not be sad that we didn't play this at all. Visa, MasterCard, very nice things to play, to sell puts on tactically for the income. TMOS as well. UNH as well. Walmart reporting. Jesus, this guy just cannot stop. Walmart reporting and Costco reporting much later. But generally everything is fine and dandy. If we get a retracement, I'm probably going to sell puts on Costco and Walmart again as well. And then we are looking for Nvidia, and we've been highlighting Nvidia and AMD as a potential great place. Nvidia is the biggest beneficiary, obviously. AMD as well. We are looking at short. Let me open. Long this guy up to $120. I'm not gonna get into fundamentals, but this looks very promising to us. A couple of names to play volatility crash in, like Home Depot reporting, TJX reporting, Walmart reporting, yes. And I guess that's it. I guess I have. We entered longs in MDB, and we got into the WD CrowdStrike on the long side, and to that we sold Kairos, the Japanese restaurant chain. That's it. The environment is fine. Generally, I've given our thoughts on crypto and SPX, and this is it. Very good time to take on some risk on a short-term basis, meaning 1 week to 1 month short-term basis for us. Thank you for listening. If you have any questions, please drop them in the comments below. I would like to answer them.